So basically, what is IS 12 talking about? IS 12 is talking about income taxes, and the major part of it is the deferred tax. And the deferred tax aspect is what I always test, because that aspect is the tricky area. That if you don't understand it, you won't be able to solve it. And income taxes is one of the strong standards that not just anybody can take it. When you're talking about standards that are solid, we talk about income taxes, we talk about financial instruments, we talk about lease, we talk about any per shares. Those are the standards that are standard. Others are standard but not that standard. So they are simple to understand. Within few minutes, I'm done with it. Like PP 16, like 38, like 2, like 15, like 36, 37. Like 37. 37 is not that important. Provision, liability, and stuff. Impairment is 36, Abi. So online, can you continue? Can you hear me?
Yes, I can hear you now, but it went off for a few seconds.
All right. So those are the standards that we know that, but I can like to test all these solid standards. You understand? So that is why in a diet you must touch all those standards. Now, let's start. IS 12, what is it talking about? It's talking about two things. It's talking about current tax, how to arrive at current tax, how to arrive at deferred tax. Do you understand? So the first aspect is that it talks about the current tax. And the current tax here we are talking about is you make profit of what? Of 20 million. And your tax rate is 30%. So definitely your current tax will be what? Will be 30% multiplied by that figure. You understand? Then when we are now talking about the deferred tax, it's now talking about the difference. The issue is we have two perspectives. One perspective is the accounting aspect, and the other one is the tax aspect. There are some things that accountants will do that the tax people will say, never, they cannot accept that. So because of the disagreement between the accounting and the tax basis, we always have what we call the differences. And the difference will now cause what we call the factors. So, for example, we all know how to arrive at the carrying amount of a particular asset. Let's say the cost of that asset is 20. When you charge your depreciation is 5. So accountant will recognize this as what? As 15 carrying amounts. But the tax people will never agree that your carrying amount is 15. They will say your depreciation is not allowed. Your cost still remains 20. They will now calculate their own capital allowance. That capital allowance will replace accounting depreciation. Let's now assume the depreciation is now 7. So 20 minus 7 will give us what? 13. So they will say 13 is your carrying amount. So the difference between what our accounting has recognized and what the tax people has recognized is what we call temporary what? Difference. And the difference is what? Is 2. So as a result of these temporary differences now that we are going to have, we are going to arrive
Hello,
at,
sir.
Caroline,
Please, sir.
oh yeah. What's the please, sir? What's the question?
I was logged out a few minutes ago. Can you recap the illustration? The illustration you are making, I was logged out.
Just follow me. So I've not done so much. So just follow me. So what we have said is accounting is 15. The tax is what? Is 13. The difference between the 15 and 13 is what? Is 2. So that 2 is what we call a temporary difference. So we are not going to look at all the assets, all the liability, what the accounting are reporting, what the tax are reporting, the differences between the two of them will come here. Do you understand? Now, at the end of the day, whatever you get here can be 2. As we have more, it will change, Abi. So we can now assume maybe this thing is 2 or it's more than 2. Now, the result you are going to have there can be in 2 forms. We can have what we call deferred tax assets and deferred tax what? Liability. Deferred tax assets and deferred tax what? Liability. Now, what is the difference between the two? This standard is very interesting and solid. So just make sure you grab it. Don't know. Slightly. Now, the fact that liability simply means you have, let's continue, please. The fact that liability simply means you have enjoyed something here now, but you are going to pay the tax what? That's liability too. So you continue to carry the fact as liability till you get to that period. Then the asset is you have already charged you now, so you are going to pay lesser tax in the future because it's an asset to you, and you continue to carry it like that. But the thing is that the thing is just temporary. It's not cash item. So as an accountant is continuing over the years, and the tax people are doing their own over the years, both the accounting and the tax will reconcile it. It will now be what? It will now be 0. It will be 0 at the end of the year. It may not be that year, but it depends on the period, duration of that transaction. But at the end of the day, it will still be what? It will be the 0. That's why we call it temporary difference. It's just a temporary. We also have another one we call permanent difference. That permanent difference is once the tax people disallow it, it can never come up again. Example is fine and penalty. If accounting people put fine and penalty here, tax will disallow it. Isn't it? Yes. And when they disallow it, they are not thinking about it or bringing it back again. When they disallow it forever. But here, are we good together now? So sorry, the network, I don't know how it's behaving. So what we are saying is, once the tax people disallow this one here is just for temporary what? Temporary period. They will still accept later. These two will balance up later. So that's why it's temporary. But there are some that are permanent, that once they reject it for life. Fine and penalties. You understand? They will reject it because it's not what? It's not allowed. So we have temporary difference, we have permanent difference. So when we are talking about calculating the deferred tax, The factors occur as a result of temporary difference. Do you understand? So let's go back to the material. I'll just go through it sharp, and we are good to go. Now, key concept of IS 12, current tax. The amount of income taxes payable in respect of taxable profit for a period. So if your profit for a period is 15,000, so what is the tax rate? Charge it on it. That's what we call current tax. Then we have deferred tax. The deferred tax effects that arise from temporary difference between the carrying amount of an asset or liability in the statement of financial position and its tax basis. Do you understand? Then the next one is, what is now the temporary difference? This arises when the carrying amount of an asset or liability in the financial statement differs from what? From the tax basis. So this is what we have in the financial statement. This is what the tax people have. The difference between the two is what we call temporary difference. And that is what we call the deferred tax. Pay 100% attention. Next one is deferred tax assets and liability. So there's what we call deferred tax asset, there's what we call deferred tax liability. So for deferred tax assets, recognize for all deductible temporary differences to carry forward of unused tax losses and the carry forward of unused tax losses. We are going to talk about that later. Then the tax rate, we all know the meaning of tax rate. It depends on the jurisdiction in which the companies operate. Some people are using 30%, some people are using 20%, some people are using 25%. It depends on the tax rate. Okay, now let's look at this example very quickly to start. Let's look at this example very quickly. I hope you are with the material. So number one is AB Limited has a taxable profit of 1 million naira of $100,000. $100,000 for the year. The tax rate is 30%. Calculate the current tax expense for what? For ABC. So number one is 100 what? $100. And the tax rate is what? Is 30%. So what will be the tax expense for that year? $30. Is it 30,000? $30,000. So $30,000 is the what? Is the tax for that year. Now, one thing is to know how to calculate the tax. Another thing is to know how to what? How to treat it. Treatment for the tax here will now be what? Because it's a tax expense. You will debit 30,000 into P or L, and then you credit the same 30,000 into what? Into balance sheets, which is the statement of financial position. This one would be under tax what? Tax expense. Under P or L as an expense. Then this one will be under current liabilities. And that's all. Are we good to go? That is the treatment. If I can want to ask you, how can we not ask you grammar? They will give you practicable question that you will show your understanding of the income taxes. Okay, let's go to question 2. Question 2 is talking about where is it? At year end, as I said 2, the factors liability calculation. At year end, XYZ Limited has the following. Carrying amount of the equipment is what? 120,000. That's the carrying amount. Yes or no? Yes. Then they said the tax base is how much? 100,000. What is the difference between the two? The difference is what we call temporary what? Difference. The difference is 20. That 20 is the temporary difference. This temporary difference is not in the factors itself. Until you now charge the tax rate on that difference. What is the tax rate? 30% multiplied by $20. What is the tax? What is the VAT tax? 6,000. So $6,000 is now your deferred tax. You now need to know if this deferred tax is deferred tax assets or what? Or liability. How are we going to identify if it is deferred tax asset or liability? When we get there, I will explain better. But just know that as at this period now, $20,000 is not your deferred tax. Your deferred tax is what? Is 6,000 until you apply the difference on it. Are we good to go?
Yes.
Now, question 3 now. They said Deferred Limited has to carry forward tax loss of $50,000. The tax rate is 30%. Calculate the deferred tax assets that Deferred Limited can recognize. The same thing, the $50,000 is what? Is the carrying forward of losses. At this point now, you don't need to do any difference again. You just apply the tax rate on that loss, carry forward loss. And how much is the loss? $50,000 is the loss carry forward. Multiplied by what? The 30%. What is the difference? What is the answer? So $15,000 is your deferred tax. Don't forget, I'm here to identify if it is deferred tax liability or what? Or asset. But I don't want to jump into that. I want you to understand the basic, how to identify that. We are good to go. That is just a simple question to lay the foundation. That is a simple question to lay the foundation. Now, let's now go into overview of the tax under IAS 12. Overview of the factors under IAS 12. What is it talking about? Determine whether there are temporary difference between the carrying amounts of asset and liability and their tax basis. That is, anytime you want to solve question, anytime you want to attack question under IAS 12 that has to do with the factors, the first thing to know is to see this is the accounting, this is what? The tax base. Is there any difference between the two? If there's a difference, establish that difference first. Like the first one we have done, 15 minus 15, the difference is 2. That is the first step. The second step is determine whether there are unused tax losses and unused tax credit. Just like what we have done now. When there is unused tax losses, what do? You just apply the tax rate on it. Then the next one is determine whether IAS 12 prohibits or restricts recognition of the VAT on any deductible temporary difference. That is, it's not all the transactions that are allowed to calculate the VAT on. Before, they don't always calculate the VAT on leases. But recently, they just did amendment to IAS 12 on that. Now, the factors can now be calculated under leases. You don't understand? But before, they don't always calculate that. So, you have to recognize if these factors, if this particular transaction is restricted under the factors on. Next is recognize the factors on all temporary difference. That is, as many given to you, even if it is 10 transactions, you must compare one by one to tax basis and see their differences one by one. Are we getting that gist? Next is measure the factors using the rate of the tax rate of the jurisdiction in which the company operates. So if it is tax rate, you apply. If it is 20%, you apply. If it is 25%, you apply. Then next is allocate any income tax charge or credit for the period to profit or what? Or loss. Or other comprehensive income or equity as appropriate. So it means you can charge them to profit or loss. You can charge them to OCI. It depends on the treatment. You understand? Then present income tax in the financial statement as required by what? IAS 12. Then last one, disclose information required by IAS 12. That is the steps we have to follow when we are preparing tax. Okay, let's move on. So now, when we are talking about these deferred tax, we want to look at the formats. We always have the carrying amount. We have tax base. We have temporary what? So the carrying amount is the same thing as the accounting I put in the earlier. So what are the items you can have under the carrying amount? There's no limits. As long as you can have them in the financial statement. It could be assets, PPE, equipment, motor vehicle, receivable, trade inventory, payable, other payables, loan, whatever. As long as there are many, we bring them here. So it now depends if tax agree with them or not. Then we have rules that we know if tax people will agree with this or not. You know, tax people actually deal with cash. It's like cash flow, cash basis. Mostly they deal with cash. They don't want to hear anything about provision. Accrual, no. It must be cash basis. So you will bring all those figures. In the question, they will give you the accounting. You will be the one to know, based on the tax basis, if it will be accepted or not. You will now find the difference. The differences will come down to this. Do you understand? Now, let's leave that part. Let's now go to how to identify if it is the factors, if it is the factors or not the factors. If it is the factors or not. Now, if you look at the diagram in that material, you will see the information there. We have 4 scenarios. Let's talk about the 2 scenarios. When you're talking about the factors assets. Mute your mic, Damilola. So we said when assets and assets are compared, and when liability and liability are what? Are compared. The first one is when the carrying amount, this is carrying amount, and this is the tax. This is carrying amount, and this is what? The tax. So if you look at the first one, we have what? We have less than. This is less than here. And the second one, we have what? We have greater than. Are we good to go? Now, what he's saying is that when carrying amount of assets is lesser than tax base of the assets, what do we have? We have deferred tax assets. What we are trying to show
is I didn't hear what you said.
Total focus and attention, please. This is the main game of the topic. So this is carrying amount. And this is tax base. This is temporary what? Difference. This is what we are saying. when the carrying amount of the asset is 20, let's say this is PP, is 20, and the tax aspect is what? Is 30. Yes or no? Because the carrying amount is lesser than what? The tax base. What do we have? We have 10. But this 10 is what? Is an asset. Are we good to go? It's an asset. That is how you're going to know that this is a just look at it. What sign is this?
It's lower.
It's lesser. So when this one is lesser than this, then it is okay. It should be negative. That's what I'm saying. Okay. So when it's like this, it means this is an what? It means this is an deferred tax asset, but it's not deferred tax yet. What will be the deferred tax asset here?
Tax rate.
So it will now be 30. It will now be 30% of 10. So that would be 0.3. 0.3 is the deferred tax asset, not the 10. Not difference. Is the tax rate applying to it. Are we getting that just now?
That's what applying to the
10.
difference.
Do we understand now? So the other way around of this is when the liability is now greater than what? The tax. That is, let's use payable, for example. Payable is the liability, Abby. So let's say payable is 30. And this is what? Is 20. Difference is what? Is 10. This is what? An asset.
You don't understand. This is payable.
Because it's under liability.
The kind of liabilities is higher than the tax place of liability.
Is it not
I
high?
need to come again.
I
This
know.
last sir, please, I don't know if you can come again. I didn't understand it. The differ assets.
Payable is liability. So why become how do you become tax? Become asset.
Yes.
I will explain the reason behind that asset. Do you understand? But looking at the interpretation of this formula, no, the fact tax, I expect that's why I say it's not the standard. It's not just everybody that can take the standard. So let's take it again now. The formula is assets at current amount is lesser than assets of tax base, which we have interpreted here that PPE is an asset and the current amount is 20, the tax base is what? Is 30. The difference is 10. Definitely, we have to concur with this formula, which means this one is a what? It's a deferred asset. But not yet deferred asset until we apply the tax rate. But this temporary difference is an asset. Are we good to go? The second one is payable. Payable is under liability. So the formula for asset and liability is not the same thing. It's the other way around. They now said that when the liability is what? When the carrying amount of liability is greater than the tax base, then it becomes an asset. So it should now be when the 30 is now greater than the tax base of 20, the 10 is now what? Is the asset. It's the other way around. How is it like that? Now let's look at it deeply now. Why is it going to be asset? Let's look at it. Here is 20 naira. Let's say the initial cost of that asset is 50. Initial cost of the asset is what? Is 50. For accounting to get this 20, what do you think they must have done? They must have charged 30 depreciation. Yes or no? To have given them that 20. The cost still remains the same thing. For these tax people to have gotten this 30, they must have charged, lesser capital allowance of what? of 20. This is allowance. Are we getting that gist? Now, let's now assume that our profit for the year is 100. Accountants will do their own. What will be their depreciation? 30. What will be their profit? 70. 70 is their profit. So the tax they're supposed to get supposed to be 70 times what? Times 30%. What will be the tax they're supposed to pay? 21. So 21 should have been the tax they're supposed to pay for that year. Are we good to go? But look at it. When the tax people now want to do their own, they say, yes, we agree that your profit is still 100,000. But this your depreciation. We no agree. We no agree. So the removal, they said is now 20. So it means you have profit of what? 80. 80 times 30%, what do you get? 24. You are not paying tax of 24 instead of paying tax of what? You are paying higher tax today. But in the future, you will pay lesser tax. So it's like you are keeping 3 naira as an asset that I'm going to enjoy in the nearest future. That is why it's an asset to you. Do you understand that now? That is why we call it the father's asset. Because it's a future benefit. Do you understand now? Online, any question on that? Fine, it's very clear. Now, that is what the deferred tax aspect we talk about. Now, let's now go to how to determine the liability. I mean, the deferred tax liability. If you pick this one also, it's still the same aspect of it. If you interpret, we still give it the same. So let me snap this one. Then let's go to the deferred tax liability and then deep meaning in this way. Before we now start picking questions one by one. The first thing is to understand. What do you say?
I'm confused, sir.
On
this, yes. I didn't join early because of network, but with your explanation now on this, the 3 naira difference being a profit in the future, please, I don't understand it.
So a profit is an asset in future. I will explain again. I will recap that again. Let me just snap and send to the platform so that you can pick it up from there. Okay, so what we are saying is this. Deferred tax. So deferred tax assets simply means the difference between the carrying amount and the tax base. So, and the rule says here that when you have lower carrying amount compared to the tax base of the asset, then it is an asset. So I'm only proving why it is an asset using this illustration. And why it is an asset is the cost is 50. The depreciation is 30. The cost is still remain 50. The capital allowance is what? 20. When you have 100 minus 30, you will pay 70, you pay 30% on 70 naira. But when it is what? It is 100 minus 20, you pay tax on what? On 80 naira. Your normal tax supposed to be what? 21. But because of tax people, they said, because of disagreement between you and tax people, they said you are paying 24. No, voila, we are going to pay. The only thing is that I'm paying my tax in what? In advance. because the difference between this one is 3 naira. As opposed to pay 21, I'm paying 24. That 3 naira, I'm paying it, I'm depositing it with you of that 3 naira. I'm still going to enjoy it later. So because I'm going to enjoy it later, it's like a receivable to me, though it's not a receivable, but looking at it from accounting terms, it's like a receivable to me, like deposit. So that is why we call it an asset. That's why we call it an asset. And that is the proof that this is the deferred tax asset, because you are still going to enjoy it in the future. Now let's come back to the other side of it. This is the deferred tax liability. So if you look at it very well, you will see that if you can get the first two that we just explained now, to get the other side is not difficult. It's just opposites, opposites, opposites. Do you understand? The first one here is talking about asset versus asset. But in the first one, it was less than. But now it's now what? It's now greater than. The second one is also liability and liability. In the first one, it was greater than, but now less than. So if you get the first one, you will actually, definitely get the second one. So we now say when assets, that is the carrying amount, is now greater than assets of tax base, it is liability. I'm going to put this one here. Then the other side is liability, which is carrying amount. When it is lesser than liability of tax, then it becomes what? It becomes deferred tax liability. It becomes deferred tax liability. Now, let's prove that again. Let's say this is the carrying amount, and this is tax base, and this is temporary what? Temporary difference. So let's pick PP again. Now, it is now 30 because the asset is now greater than what? It's now greater than the liability. It's now greater than the tax one. So the tax one we have what? 20. The difference is still remain 10. This time around is now what? It's now liability. Then for the payable, when the payable is, they said the current amount is lesser. So it means it now be 20, or maybe we should use another figure entirely here. So that will not be confused, Abi. Let's say 40. Let's say 20, 40. Or 20, yes, 20, 40. So this will be what? Be 20 liability. Then this one will now be 40 again. Then to also give us what? It also give us the liability. So it's not tax, it's not the deferred tax yet. But the temporary difference is what? Is liability. Now let's prove it. Why is the liability? The cost of the asset is what? Is 50. The tax people, what they want to charge, for them to have arrived at 40, what do you think they have charged? They have charged 10 as depreciation. So this is their depreciation. Then 50, for them to have arrived at what? It means the capital allowance is what? 30. That's allowance. So let's assume their profits still remain 100. They will less what? 10. They will pay tax on 90. What is 30% of 90? 23. 27. So they're supposed to pay tax of 27 naira. But that is what they presented to tax people. Tax people say, no, I bet we don't want to eat your money. We are not interested in eating your money. They said is going to be that when you less it, it will be 70. 70 times 30%, 21%. Instead of paying 27 as a tax, you are paying what? You are paying 21. You are enjoying it now. But my brother, in future, you go for meter. Do you understand? So the difference here is what? Is 6. So 6 is the difference that you are going to pay in the future. So because you are going to pay it in the future, is a liability to you. Because you are going to enjoy it in the future, is an asset to you. And that is the difference between the deferred tax assets and the deferred tax liabilities. I believe we are good to go now. The foundation is strong now. Online, any question? Good, no question. It means my people online are with me. So let's carry on now. Let's now take a practical question. But before the practical question, let's quickly look at the rules in determining the deferred tax assets and the liability. In determining the deferred tax assets and the liability. Okay. So let me forward that to the group. And let's quickly go to that. We are still on the material we are using. On this same material. Okay, so let's go to the next page of the material. After the explanation of the deferred tax assets and the liability. Then determination of tax base or the rules. Number 1, the tax base of non-current assets and their cost value less accumulated what? Capital allowance. The way we have done it here, the cost of the asset is what? 50 minus the capital allowance, which is the tax base, and we got 20. That is the rule. But normally, if the accounting want to do their own, they will say cost minus what? Depreciation. Number 2, the tax base of inventory is the cost of the inventory. Tax people don't want to hear damage, something damaged, something the tax people will be get. But in accounting, you can say, okay, our inventory at the beginning is 20. We have damage of 2. What will be our closing inventory? 18. Yes or no? But when they get to tax people, they will say, so you dey 1 million. 20. Now 20 we go agree for tax people. Are we getting that gist? Are you sure you are getting the gist? Yes. The next one is number 3. The tax base of any income or cost subject to tax base is what? Is nil. Is nil. Okay, we are going to look at the examples for you to understand what we are saying in that grammar. The tax base of trade receivable, that is accrued income and other receivable, in respect of income subject to tax in the period when the incomes occur, or not when amount is received, will be the same with its carrying amount of the received. By the time we start taking all these questions one by one, I will be referring you to the. Okay. Next one. Mute your mic when you are joining. Onyeka. Thank you. Let's continue. The tax base of the trade payable, accrue expenses or other payables in respect of expenses subject to tax in the same period. I think we've read this one. When the expenses occur and not when amount is paid, will be the same with the current amount of the payable. The tax base of financial assets, that is debts and equity investment, and financial liability, that is loan liability, are usually their normal what? their normal or principal value except otherwise stated. Then the next one is tax base of research cost. Is the same amount of the research cost, the amount incurred on the research activities. Tax base of income in advance or deferred income upon end is what? Is nil. That is, tax people don't want to hear advance. People pay all in advance. So you are now giving us portion of it as accounting. You know, for accounting now we always recognize the deferred income. Maybe someone pay us 1 million and the 1 million is for 1 year. So, or it's for 2 years, 500 per year. So the first 500 will be part of our profit this year. Then the 500 will be next year. But tax people will say no. Since the money has been received, we are dealing with money here. My brother, yes. If us the whole 1 million naira is new, we don't want to say anything like 500 as the per income. Okay. Then the next one is the factors of, tax base of items that will not be subject to tax, both in the current period and future period, will be the same with carrying amount of the payable. And lastly, the tax base of all provisions are what? And nil. They don't want to hear and make provision. You are making provision of 30 million naira. When tax people see it, they will just add it back. They will say, nil. We are not accepting this one. So it means if the provision of 30 million was made in the year, what would be the, let's do this one as a classroom. Everybody, write it in your notes. An online physical. If the provision for the accounting was 30 million in the year, what would be the factors? Number one, let's take it this way. Let's write this one. If the provision for accounting is 30 million in the year, number one, what is tax base? Number two, what is temporary difference? Number three, what is deferred tax? Number four, identify if it is deferred tax assets or liabilities. That's that question. I can even take it to 6. If accounting provision for the year is 30 million, are we good? If accounting provision for the year is 30 million, number one, identify the tax base of the provision. Identify tax base of the provision. Online, are we together? I hope you are with your pen. Number two.
Yes, sir.
Good. Number two, identify temporary difference. Identify temporary difference. Right, so, madam.
Sir, is it the revenue for previous example that we are using?
What do you say?
Is it from the illustration you gave earlier, the revenue?
No, just this illustration, if you grab what I've been saying since morning, you'll be able to get what I'm saying. If the provision, the last statement I made here under the determination is the tax base of all provisions are what? Are nil. Yes or no? Yeah. So now my question is this. If provision for accounting is 30 million naira for the year, number one, determine the tax base. Number two, determine temporary difference. Number three, determine the deferred tax. Number four, identify if it is deferred tax assets or what? Or liability. Number five, show the journal entry. Show the journal entry. Show the journal entry. Sharp, sharp. Under 5 minutes, you should finish this one. If you understand what we have been doing, within 5 minutes, you are done. Let's do that one to test ourselves. If you are ready, I'm ready.
Sorry, my network went off. I don't know if it's possible to say the question again. I was logged out.
And sent to the platform. I've repeated the question 4 times now. That's all I want to start.
Okay. Let them snap and send. Thank you.
Based on what we have been saying since morning, you should be able to get this answer correct. If I've not been wasting my saliva since morning. Are we good? They're done. Okay. Anybody online? Is anyone? Can anyone answer us if you are done online?
Still waiting for the question to drop on it.
Don't worry, let's do the correction together. Anyone online?
Sir, shall we assume the tax rate to be 30%, right?
Yes, assume the tax rate is 30%. Thank you. Assume the tax rate is 30%. So what is our answer? We have carrying amounts, we have tax base, we have temporary limit. The thing is provision.
Yes.
And we said for the accounting is what? 30 million. Yes or no?
Yes.
So for tax base, what is the answer?
You.
Nil, abi? So what is the temporary difference?
30 million. That's number 2.
30 million. So this is number 1. Determine the tax base. Number 2. Temporary difference. Number 3. Is it an asset or liability?
What are the factors?
What is the factors? So the factors equals to 30 million multiplied by 30%. Is what? 9 million. So 9 million.
9 million.
9 million is your what? Is your deferred tax. But we don't know, maybe it's deferred tax asset or liability. So is it going to be deferred tax asset or liability? Why is it liability? Look at it. Provision is always the liability, it's not an asset.
It's an asset, though.
Provision is a liability. So when the carrying amount is lesser than this, that is asset. I mean, that's the liability. But in this case now, the carrying amount is greater
Than the tax base.
why the tax base is nil. Yes or no? It's the opposite of this, and the opposite of this is under asset.
Yes.
Yes or no? So this one is a deferred tax what?
Assets now.
It's assets now. Does it relate to this thing here?
No.
The carrying amount is lesser than. Wait now. When the carrying amount is lesser than tax.
Oh, it's lesser. It's less. Oh.
When the carrying amount is lesser, that is liability. But now carrying amount is greater.
It's greater.
Yes or no?
It's an asset.
It's an asset now. So that is deferred
Deferred tax asset.
asset. This matter is not clear. Go and check your notes.
Like saying,
Oh yeah, but the big you have written deferred tax assets. Whatever, check it. It's not asset. This is liability.
Liability now.
Yes, provision is a liability because when you want to make provision, what do? You expense, debit provision, credit the liability. So provision for that year, the one that you debited is going to P or L. That one has gone. But the one that is going to current liability is now the one that we are carrying for. So you can see, with just one statement, I've tested how many questions? Like 5 or 6 questions. They said we should now treat. How do we post it in the account? How do we post it account? We say debit P or L with what?
9 million.
With 9 million. And credit deferred tax assets. Deferred tax assets will be under what? Under non-current assets. But it has to be separated. It has to be a line item. You cannot add it to asset there.
Oh, separate line.
It has to be separate line as a deferred tax. Online, are we getting the gist?
Yes, sir.
Yes, sir.
Okay.
We cannot see
Now,
what you wrote though. Maybe the camera.
you can't see what? You can't see the workings of what you say. Can you see it now?
Better now, better.
Yeah, sharp, so that we can go to the main question. Now, I believe that we have a solid understanding of IAS 12. Now, let's take 3 questions sharp within the time we have. 3 questions and we are good to go. Okay. I don't need to snap. Now, who is ready for us? Can someone help us to read question 1, illustration 1? Illustration 1 is talking about ABC made a profit of 6,500 something. If you are there, I'm there. Determine the taxable profit for the year and then calculate the current tax expense if the applicable rate is 30%. If you are here, I'm there.
I should read.
Yes, you can help us.
ABC made a profit before tax. ABC made a profit before tax of 6,500,000 for the year ended 31st December 2023. Upon tax investigation, the following was observed. Number 1, depreciation charge for the year amounted to 1,380,000, while the capital allowance claimed for the year was 890,000. Number 2, the operating costs include allowance for doubtful debt, less allowance on receivables of 70,000 naira. A deduction for the debt is only allowed for tax purposes when the debtor enters liquidation. Number 3, the company incurred fines 95,000 naira during the year ended 31st December 2023. Number 4, interest income and interest expenses for the period ended 31st December 2023 were 45,000 naira and 92,000 naira respectively. Both interests are still outstanding as at 31st December 2023. The interest income is taxed and interest expenses are liable on a cash basis. Number 5, the revenue for the period includes a non-taxable income of 60,000 naira. Number 6, the impairment on intangible assets and property, plant and equipment for the period ended 31st December 2023 amounted to 127,000 naira. Required, determine the taxable profit for the period ended 31st December 2023. Number 2, calculate the current tax expense if the applicant.
Okay, thank you so much. You have already finished it before the network issue. So what they ask us to do is just to calculate the taxable profit. Here, there's no deferred tax question. It's just a tax aspect, a pure tax under IAS. No, IAS7 is the cash flow. Okay, the adjustment. So, what is the name of that? ABC, Abi?
Yes.
ABC. So, what they want us to calculate is adjusted or taxable what? Profits. Do you understand? So what is the profit for the year they are talking about? Is it profit before tax or what do they call it?
6.5.
So they call it profit before tax, have you?
Yes.
Yes.
Profit before tax. So it's 6.5 million. So we all know how we did our cash flow. No? So add backs. What are we adding back?
What's some expenses? Not cash items.
Depreciation. What is depreciation? 138,000. 380.
Yes.
Yes. What again are we adding back?
Interest expense.
Interest expense. Is interest expense there?
Yes.
Interest expense. How much is that?
35,000. Sorry, 92,000.
92,000.
Yes.
Interest income. Interest income will be deducted.
Yes.
Interest income. How much? 45,000. Ah, this marker. This misbehaving. We will deduct this. What again?
Fine.
Yes.
Yeah.
That place you should add slash yes.
What?
Okay, add that.
Yes.
Okay, go ahead.
Fine.
Fine.
Fine, there's a fine of 95,000.
Fine of 95.
Yes.
That 95, are we adding or we are deducting? They will
We are
never,
adding back.
they will never accept the fine with you. That's it. That fine. That fine, is it fine and penalty?
No, it's just the
The fines, is it temporary difference or permanent difference?
Permanent.
Permanent. This type of add back can never cause the tax to happen. So let's get there. What next after this? After fine.
Look, you have to get now provisions.
Operating costs include allowance for
That's what I'm saying here.
Doubtful debts.
Allowance for that. 70,000.
Doubtful debts.
It's allowed.
7,000, I mean.
70,000.
70,000 is allowable.
Doubtful debts.
Doubtful debt.
Is allowable for tax purpose according to the question here.
Okay, they say it's allowable.
Okay.
Yes.
You are allowed for tax purposes when debtor enters into liquidation. So there's a clause.
So since it's allowable, we have to allow it there. But where is it here?
Number 2.
Only the clause. Say only when
There is provision. There is provision.
it's provision.
Anything provision is allowed. I mean, disallowed.
It's allowed, yeah.
Anything provision is disallowed. Do you understand? Yes. Anything provision, that matter. You don't accept it. The same thing with your tax people. What's the next one?
Not taxable income.
Not taxable income.
That's not taxable income. That's capital allowance.
Not taxable income.
Capital allowance.
Is what? 60,000.
I want to ask a question.
That's not taxable income.
You already said that they will include.
Sir, this interest income and interest expenses that we are including in our computations. I was thinking before they arrived at this profit, it must has been included.
For them to, that's the reason now.
Exactly.
It must have been included, but it's not supposed to be taxed. These two, because you call them non-taxable income. It's not taxable income. So it should not be part of what we want to tax. Because whatever we get now is what we are going to tax. So we have to less this profit by this amount. Then interest income, interest is not supposed to be taxed again. If you tax it again, it means it's sovereign for two taxes. Because there's a withholding tax on it when you are getting your interest income from bank or anywhere you fix the money. So if you are charging it, if you are charging another tax on it, that is double taxation. So that is why we need to less it from what we want to tax. Do you get that?
Okay, thank you.
Any other thing? Impairment is also non-cash item, Abi. Impairment. Just apply all you have done in IAS 7. How much is the 127,000? 127,000. Add back. What again? Now, so yeah. Addition, subtraction, what you get. Whatever you get is a taxable profit. You see that all icon paper are interrelated.
6779.
677.
9. 6 million. 779,000.
This is our taxable profit. But what they ask us to do is what? What is the requirement again? So what is now the taxable profit? This is the taxable profit. We have done number 1. What is requirement 2?
Calculate the current tax rate.
Just apply the space.
Are we sure we have checked all the questions we're supposed to pick?
Claims for the year.
You are not supposed to include capital allowance. So.
Capital allowance.
This is taxable profits now. You are not supposed to include it here.
We have depreciation of 138 Yabi.
Yes.
We have doubtful debt of 50.
Yes.
We have fines of 95. Abi?
Yes, 95.
Of 95. What again? Interest income 45. We deduct. Interest expense. How much is our interest expense? 92. No, be so?
Yes.
Then we have impairment 60.
Payment? No. 127. No, that's why it's there.
Okay, non-taxable income is 60, Abi. Okay, so impairment is 127.
Yes.
And after adding everything together, we have this figure. Are we correct?
Yes.
The calculation is right?
Yeah.
I don't think so.
Make una check well.
The depreciation is 1 point. The depreciation is 1,380,000 now.
Depreciation is what?
1,380,000.
That's what we have. Can we calculate it again?
Yes.
Can we confirm again?
And that is what we wrote now. 1,380,000. That is depreciation. That is what we did.
The taxable profit I got is 8,159,000, not 6,779,000.
Okay. 8 what?
8,159,000.
59,000. So our taxable profit is this, Abi? Yes or no? And that is requirement 1.
Yes.
Requirement 2. What they ask us to do in requirement 2? So current tax expense will now be adjusted profits, which is 8,159,000. Then less what?
Capital allowance.
Capital allowance. What is our capital allowance?
Yes, something.
What is our capital allowance? Oh yeah. So we don't close the book.
890,000.
890,000.
890,000.
So how much is that now?
759.
759. 769,000.
Yes.
So the tax will now be 30% multiplied by 7,269,000. What will be our tax? 30% on it.
2 million.
2 million.
80,000.
180,000. 700. So this is our tax. Are we asked to do the posting, the journal entries? Okay, no. But as a bonus, what is the journal entry for this?
The report on loss. And credit correct assets.
And debit tax expense.
Oh yeah, put it there. Debit tax expense.
The credits and credits correct assets.
So it means the treatment.
No, it's assets.
The treatment will be debit tax expense.
From POA.
Yes, that's P or L.
It's liability.
Debit tax expense, which is P or L.
And credit contract.
Then credits and tax liability. That is under current tax. I mean current liability. Now, with the same amount. The treatment is that. Any question on that? So
This question just look like the way we do computation of tax liability in taxation.
that's what I'm saying now. So they are related. The only thing is that the tax in normal tax will not reach the deferred tax. Because tax people don't recognize. It's accounting people that we use to recognize the deferred tax.
I think they say we find separate difference. We now have an accounting commission and then tax base beside it. So if there is a liable that.
That's now
You can't have the temporary difference here for now.
No, it's just as if we have more further question.
Let's take the second question. The second question we'll talk more on that. So I've sent this thing to the platform already. You can pick it up from there. Okay, so who is there to take the second question for us? Question 2.
Okay, illustration 2. You are provided the following information regarding assets and liability as at 31st December 2021. 1. Plant cost 200,000 when it was acquired. Depreciation charge to date amounted to 50,000, while accumulated capital allowance of 80,000 has been claimed. 2. Interest receivable in the statement of financial position is 6,000. The interest will be taxed when received. 3. Trade receivable have a carrying amount of 20,000. The revenue has already been included in taxable profit. Number 4. Other receivable have a carrying amount of 8,000. This is taxable when the amount is received. 5. Inventory has been written down by 2,000 to 30,000 in the financial statement. The reduction is ignored for tax purposes until the inventory is sold. 6. Current liability include accrued expenses of 14,000. This is deductible for tax purposes on the cash base. 7. Accrued expenses have a carrying amount of 7,000. The related expense has been deducted for tax purpose. Required. Calculate the temporary difference as at 31st December 2021 and state whether it is a taxable or deductible differences. 2. Calculate deferred tax asset or liability, assuming tax rate is 30%. 3. Show accounting entry, assuming there were no opening balance of deferred tax. 4. Financial statement extract as at 31st December 2021 with respect to deferred tax only.
Thank you so much. So we have question that we have to treat. And what they are is to calculate the what? The first one is what? Calculate the difference, I think. The temporary difference. So to calculate the temporary difference, number one, we need to compare the current amount to tax base. Then we have temporary what? Difference. So the first item we have here is what? What's the first item?
Plant.
Plants. We just call it plants. So for plants, in the question, in that question, it not give you the kind amount of the plant. So you will be the one to calculate it. But the cost of that plant is what?
200,000.
200,000. What is the depreciation charge on it?
50,000.
So 50 minus 200 is what? 150. So
150.
So it means the carrying amount is 150,000.
Yes.
But compare this to the tax base. The tax people will not agree with 50,000 depreciation. Yes. They will rather replace it with what? What is the capital allowance? 8. So the tax people will be having what? 120,000. What is the difference between the two? 30,000. The temporary difference is 30,000. It's like we have already answered 1 and 2 together. So let me quickly add this. Okay, it's what we have. Okay, so now quickly, this apply the rate. Okay, fine. So quickly, what type of tax is this? Well, if you want to do it by the side, you can do, but let's do all the differences. Plus, minus, at the end, we not apply the tax rate. So now this 30,000, is it deferred tax liability? No, is it temporary or liability?
Deferred tax.
Deferred tax liability.
Get deferred tax yet at this point? Yes or no?
Yes.
This is just temporary difference.
Yes.
So the temporary difference, is it an asset or liability?
Liability. But the carrying amount is greater than the tax base.
Okay, so the carrying amount is higher than the tax base, have you? Yes. So that is the asset. Liability.
It's you.
Go back to this. Go back to the formula I gave to you. Go back to that.
That is an asset. Carrying amount is lesser than tax. Carrying amount
is greater. It's not less.
This one is greater now. That's liability.
Is it liability? And that's what they said.
That's what I'm saying.
Okay, it's not the result.
It is because their tax base, the account ratio is more than tax base, not because. I don't remember.
But do we understand now that this one is the tax, is the liability?
Because that's the account between the asset base.
That's what it for here.
As long as you just know how to grab your method. Okay, online, are we together?
Yeah.
So let's pick number
2. Yes, we are
two.
together, sir.
Okay, fine. What is number 2? What is number 2 saying? Okay, so interest receivable. Let's look at that interest receivable and let's see the way they put the question. They said interest receivable in the statement of financial position is what?
6,000.
Is 6,000.
6,000.
That amount is 6,000 because that is the accounting figure. Do you understand? That is accounting figure. It's not provision now. It's a figure. Now, they now continue. They said the interest will be paid. Is it paid?
Will be taxed when received.
So the interest will be charged when what? When received. It
Received.
means they are yet to receive it. Do you understand? Like she said, it's like a provision. We have not received it. We are only making provision for you. Tax people will not agree because you are yet to receive it. So what are they going to do? They will disallow it. So the tax base of this will now be interest what? Is it interest received? They call it receivable. So let's call it interest receivable. So they said it's 6,000 under accounting in the financial statement, but tax people will say no, we are dealing with what? We are dealing with real cash.
Is zero.
If we are yet to receive it, we are not going to recognize anything for it. It's nil. So the temporary difference here is what? 6,000. People of God. Is it liability or assets? It's liability.
Okay, it's the same thing as the first one.
The same thing like the first one.
Yes.
Let's move on. I believe online are with me in full flesh now. Let's go to the next one. The next one is number what? Number 3. Number 3 says, trade receivable have a carrying amount of what?
20,000.
Of 20,000. The revenue has already been what? Included to taxable profit. The revenue have been included in taxable profit. It means they have already recognized it. They have already received it. For them to tax it, can you tax what you have not received? So tax people will say you are a good boy. So receivable is 20 under carrying amount. Then tax people will also, yes, we agree with you, it's 20. So the temporary difference here is what? Are we good to go? That's it. Since it has been already taxed, you can go back to the determination of basis, the rule. You will see that.
Sorry to cut in. In exam, this is how the questions on IAS 12 comes in. We'll just solve it like this.
Just hold on. When we are done with this, you know, there's no way I will not refer you to Pathfinder. Let's solve these 2 questions. After this, we have another 1 question. When we are done with that, we will now go and solve 1 question in the Pathfinder. You will see the same way they put the question. So no difference.
Okay, sir.
In a short answer to your question, this is how they used to put the question. So we are going to express it when we go to the Pathfinder soon. So number 3. Is it number 4? 4. Okay.
This is the are we not doing this?
There's no temporary.
Okay.
There's no temporary.
There's no difference. So no liability, no assets.
There's nothing you apply.
No liability, no assets. There's no difference.
Yeah.
So let's go on number 4. Other receivable have a carrying amount of how much? Of $8,000. This is a taxable, or this is taxable when the amount is what? Is received. Do you think they've received this money?
No.
So will tax people allow it?
Yes.
No.
No.
So
Nihil.
when it's received.
When is it?
So what do we call it again? Sorry. Order receiving. Order receiving. 8,000. Tax people will say about no. Then the difference is what? 8,000.
8,000. Liability.
So we go to number 5. Number 5 is inventory. Inventory has been written down by $2,000 to 30,000. In the financial statement, the reduction is ignored for tax purposes until the inventory is what? Is sold. So you are yet to even sell the inventory. You are already writing it down. Wait until you sell the inventory and the value is no longer the same thing. But this 2,000 you are doing is what? Is a provision. You are already looking at it. No, it's provision. Look at it. The inventory, I will explain further. The inventory here, they put it as what?
That's been written down at 2,000.
It has been written down to 2,000. So it means
By 2,000.
by 2,000 to 30,000. It means before it was 32,000.
Yes.
They now remove 2,000. That this 2,000 is what? Is damage, is what they call it again?
Obsolete.
Obsolete damage, Abi. That we are looking at this inventory now. We will not be able to realize 32,000 on this inventory. So it's better we make provision of this damage now. They now, when they want to record it in the financial statement, they recorded only 30,000. They are making provision for the damage. You understand? But the tax people will say, they play. We cannot accept 30,000 until you sell and you are unable to make that 32,000. That is when we are going to. But now there's no cash transaction. My brother, they will say now 32 we will recognize. That same amount. That's what we are going to do. So the difference will not be what?
2,000.
Negative 2. So the negative 2 will now be what? Assets. Will now be asset. Because now I will pay higher now, but because we are removing this one, I will enjoy my 2,000 when I sell it because I know with my eyes that I cannot sell it for this amount.
Yeah, if someone has known the first one,
Just
opposite, you don't liability to.
You know,
very, very clear. Positive liability.
Yes. Exactly.
When you don't get to liability.
So number 6 now. Number 6. What is number 6 saying now?
Current liability
What happened to it?
include accrued expenses of 14,000.
This is deductible for tax purposes on cash basis. On cash basis. Does it mean we are going to accept it or not?
They will not.
They said
It's an accrued expense.
accrue. What is the meaning of accrued?
They are already engaged in the monthly.
Oh, you've not paid for that event.
So if you look at it, said current liabilities include accrued expenses of 14 million. This is deductible for tax purposes on tax basis. So the opposite will be nil. If you go back to the determination, what is guiding us? Accrued, what we call it now? Accrued expenses. You said it's 14.
Okay, the tax base of income in advance or in advance.
The tax people will say nil. It's not like that. Then we have 14 as difference.
It used to be the same one. So this number 5.
For the accrued,
The tax base of trade payables, rather than accrued expenses or any other payables, in respect of expenses subject to tax. In the period when the expenses occur are not when the amount is paid. Will be the carrying amount of the payable.
As you see,
Subject is a clause.
subject to tax. They said tax deductible. There's a difference between subject to tax and tax deductible. Subject to tax means you are going to pay tax on it. Tax deductible means you are not going to pay tax on it.
Because that's already
Opposite.
subject.
Tax deductible. When we say tax deductible, it means if the tax is okay, for example, on your payroll, when you are calculating payroll, there are some items that are tax deductible. That is, you will not pay tax on them. Do you understand? For example, your pension, like your trust fund, like insurance, all those ones are tax deductible. You are not going to pay tax on it. So, based on that illustration you see, assuming this thing is taxable, assuming it's subject to tax, it will be the same thing. Because tax people will what? Will recognize it. But in this case now, they said it's tax deductible. That is, tax people will not tax it. We are only looking at what tax people want to tax here, based on tax basis. Are we getting that logic? We are going to pick another question for better understanding. Is that all the questions, or we still have more? What is the next one? Is it not the same thing you have done here? Okay, this one is accrued liabilities.
Which include accrued expenses. Then the next one is now accrued
This
expenses.
number is the asset.
Okay, so this one is accrued liability, Abby. So number 7 is now what?
Accrued expenses.
So this is now accrued expenses. Huh? Is it the question of not the, okay? Is it the difference we're talking about? Is it liability or asset? My people online, is it liability or asset?
It's for liabilities.
Huh?
Or which one are you talking about?
Which item are we
It's deferred tax liability.
So the liability of accounting.
So go back. This we all know that this is liability, Abby.
Yes.
Is that it though?
Hold on. Hold on. We all know that this is liability, Abby.
Yes.
So since this is liability, go to the liability. When the current amount is greater than the tax, which one does it fall under?
It's
Liability.
This one is greater.
Under asset is less than asset of tax rate. That's it. Liability is greater than so that
This one is under liability.
This one is under
Under liability here now.
Check the two liabilities.
Asset.
What is that thing?
It's an asset, so it's an asset.
Is that an asset?
Asset.
So if it's an asset,
Yes.
put it in jacket, Abby.
Yes.
Eh?
No, you don't put it jacket, you confuse us.
Jacket.
All these ones are liability now.
Doesn't mean.
No, it doesn't mean. You know what? You see, I didn't even follow that in again. I just look at the first one, like this. No, the second one, interest, that one is liability. It's giving us a hand. The
But-
opposite of it.
Wait, this one is liability, Abby.
Yes.
Yes.
Eh? This one is liability, Abby.
Liability,
Yes.
yes.
This one is nothing, Abby.
Yes.
This one is liability.
Yes.
Yes.
If I find the asset.
This one is asset,
Yes.
Abby. Because this one is also in jacket.
Jacket.
Move it to
Very
the
first. Let us examine now.
Okay, wait. Why is it not in jacket?
14 minus 0 is
14
14
minus 0 is
That one was
14.
jacket because 30 minus 0 is negative.
Wait, it's not because it's this minus this. It's because of the principle.
Principle rule.
What is the principle? When the liability, when this under liability, when the current amount is greater than the tax base, is it under liability, the tax liability or tax asset?
Asset.
But because this one is asset, this one also is an asset, Abby.
Yes.
Yes or no?
This liability is
Eh?
liability.
Maybe these two, wait, maybe these two are assets.
Yes.
So asset should be in jacket. I will tell you the reason. Because at the end of the day, you are actually dealing with the difference between these. If you leave this one as a positive, it means it will be 30 plus 6 plus 8 minus 2 plus 14. You will not get the same answer. So as long as this one is an asset,
This one is confusing you.
as long as this one is asset, just understand that asset should be in jacket, the liability should be open. Simple. As long as you have determined that this is liability, leave it, leave it, leave it. As long as determined that this is an asset, put it in jacket, put it in jacket.
The determination does not determine the jacket or not.
Exactly.
It is the principle that determines that.
It's the principle that determines if it is liability or an asset. But once you know it's an asset, put it in jacket.
Oh.
So that the liability will be different from the asset. Do you understand now? Do you understand? So what is the next one?
After expenses is
7,000. So what is the statement? How do they put the statement again?
After the expenses have a carrying amount of 7,000.
That's all. So we now use the
Related expense has been deducted for tax purposes.
have been deducted
Yes.
for tax purposes. What is the first one? The first one we did.
Foreign liability. This is deducted for tax purposes for tax purposes.
It's deductible. They are yet to do it. But now they said it's been deducted.
Yes.
Do you understand? So it should not be 7,000.
7,000.
7,000. So the difference is nil. So we are getting it now.
Yes.
So tax people will agree with this one because it has been deducted. It has been paid. They are talking about cash basis. So let's find the difference between these two, between these things. So whatever is the temporary difference, no? Don't let me write temporary difference now. What is the difference between the two now? The total. The net is
28,000.
28,000. Is it jacket or open? Now, since it's open, is it the VAT tax asset or liability? Liability. So it will be temporal difference liability. You can see that I've been careful.
Thank you, sir.
This one, the VAT tax asset. It's not yet the VAT tax until we apply the rate. But this is just temporal difference liability. So I'm coming. Just a moment. Then they now ask us to find what? The VAT tax, have it?
Yes.
So the VAT tax, the VAT tax liability will now become liability now based on our agreement here. The VAT tax liability will now be 28,000 multiplied by the tax rate. What's our tax rate? 30%. 8,000. 8,400.
We talk to yourself, eh?
8,400. So 8,400 is our deferred tax liability. Yes. Adedo, you want to ask the question?
Yes, sir. Sir, please, can you just recap on reason why the accrued liability is in jacket? The 14,000. I didn't understand how you explained the 14,000.
Okay, so the liability, why do we put it in jacket? Why, or the reason is why is tax base rejecting it? That is the main question, Abi, because once you know this, you know that this one will be in jacket. Is that clear, Abi? So why?
Sir, please just explain everything.
So why is tax people rejecting it? If you go back to the determination, they tell accrue expenses subject to tax should be allowed, Abi. Assuming this thing is subject to tax, we will put 14,000 to it. But because it's not subject to tax and is deductible, they are yet to deduct it. Tax people will not agree with it yet. We are accepting this one because it has been deducted already. So since it has been deducted already, the tax people will accept this. So the accounting and tax will be the same thing. But for the second one, is deductible, but it's yet to be deducted. And accrue is there in the question, they not say it's subject to tax. There are two things. If they said this accrue is subject to tax, we will accept it. Another thing is, if they say this thing is deductible and it has been deducted, we will also accept it. But here, it's not subject to tax, it has not been deducted. So tax people will not agree with that. If you look at the second one, they did not tell us it's subject to tax, but they told us that it is deductible and it has been deducted. So we have to accept this. And that is why we arrive at this figure. And because it's an asset has to be in jacket. Why liability has to be this? Why is liability be in this? Because this is a positive to organization. They are enjoying this now. They will pay it in the future. So it's a liability. They have to carry it now as liability. This one also is a future liability. They are enjoying it now. They are going to pay for it in the future. This one also, they are enjoying it now. They will pay for it in the future. But this one, they have already enjoyed, they've already paid for it. They are suffering for it now. Do you understand? So they will It's an asset now. So in the future, what will happen to them? They go for meter. I think it's even the opposite of what I've said. This is liability, Abi. The liability aspect here means they are suffering for it now. They will enjoy it in the future. They are suffering for it now. They will enjoy it in the future. They are suffering for it now. They will enjoy it in the future. While this one they have already enjoyed, they will. So just follow the principle we have discussed. People of God. What is the next thing they asked us to do in that question? They said we should present it. How many minutes do we have more?
Yeah, 14.
Ah. What they asked us to do with the next one? This is the accounting entries, Abi. What is the accounting entry?
Assuming there was no opening balance.
Assuming there was no opening balance, simple. Debit the tax expense, Abi, and credit the tax liability. Credit the tax liability. Just write it there. You will credit the tax liability. You know the liability is always on the credit side now. So debit the P or L and credit the tax liability. Simple. Debit P or L and credit the tax liability with the same amount, with this amount. It's not income, it's the liability now. As expense now, it will be part of the tax expense for that year. It will be part of the tax expense for that year. You will now credit the. I believe you understand what we are saying now. So in your statement of financial position, it will be there as a line item. Accounting is sweet. Let's do the next question very quickly. I hope the time will be enough for us. Who's there to read the next question?
If you have one more question.
Yeah, that's what I'm saying. Let's read the next question.
No, I mean, this is question.
What they asked us to do again?
You can go and picture. That is very extra.
And that's what
That is your topic or not.
that's what I said now. So this one will be debited under P or L. This one will be credited under current liability as a deferred tax liability. This one will be under P or L. So don't let us waste time on that. Online, can you pick the next question, please, so that we can solve
Illustration 3. The following relates to Man United for the period ended 31st March 2020. 1. Man United has a non-current asset with a carrying amount and a tax base of 800,000 and 620,000 respectively as at 31st March 2020. 2. In the year ended 31st March 2020, the company incurred research costs of 420,000 and expensed it in the profit or loss in accordance with IAS 38. Research costs are not permitted as a taxable deduction until a later period. 3. In the year ended 31st March 2020, Man United purchased 300,000 loan notes of another company as per and incurred transaction cost of 30,000 in relation to the acquisition of the loan instrument. Man United has recognized in accordance to IFRS 9 financial instruments in the financial statement using the amortization cost method. Under the tax rule in Man United jurisdiction, transaction costs incurred in relation to acquisition of investment is deductible in the period in which the investment was purchased. 4. On 31st March 2020, Man United borrowed 175,000 from a non-group company. The financial liability is designated at fair value through profit or loss. Man United incurred cost of 15,000 in connection with the borrowing and this qualified for tax relief in the year ended 30th March 2020. 5. As at 31st March 2020, Man United recognized a product warranty provision of 200,000 in accordance with IAS 37 for tax purpose. The product warranty cost will not be deductible until the entity pays any warranty claim. 6. It has recognized an interest income of 420,000 in financial statements. The interest not yet being received and it's taxed on cash basis. 7. Prepaid expense as at 31st March 2020 amounted to 44,000. The expenses are liable for tax deduction in the period when the expense is paid. 8. Interest, interest payable as at 31st March 2020 amounted to 75,000. The interest costs are liable for tax deduction on cash basis. 9. In the year ended 31st March 2020, Man United incurred development cost 450,000 and capitalized in accordance with IAS 38. The amortization charge on this development expenditure for the year amounted to 50,000. Development costs are liable expenses for tax purposes in the period in which they are paid. 10. Man United has a deferred tax liability amounted to 70,000. As at 31st April 2020, the current period tax estimated at 120,000. Assumed tax rate is 25%. Required, show the financial statement extract with regard to tax as at 31st March 2020.
All right, thank you so much. So let's start with the first one. What is the first
Non-current assets.
non-current asset? So non-current asset, how much is the non-current asset? The cost. Are you giving the cost?
No, you are carrying.
You just give us the carrying amount.
Just carrying amount and tax base.
800,000 for the carrying amount. How about the tax base?
620,000.
Eh?
620,000.
620. So it means they've done all the headache of depreciation and capital allowance. So what is the difference? That would be 180,000. This 180,000 is it an asset or liability? Maybe now look at me. Oh yeah.
It's a liability.
It's liability, Abi.
Yes, sir.
And it's better than tax base.
Okay. So it means they are charging higher capital allowance this year, which means you are going to be paying lesser tax this year. Abi, they are charging higher capital allowance this year. You will be enjoying lower tax this year, but in the future, they will wait for you to pay up. That's it. So it's a liability. Then number 2.
Research costs.
Research costs. Why they put it in that place?
In the year ended the 1st of March 2020, he said the company incurred research cost of 120,000 naira.
Okay.
And expense it to the profit or loss in accordance with IAS 38.
Okay.
Research costs are not permitted as a taxable deduction until later period.
On later period.
Yeah.
Okay. So what do you think they have done?
I think
We cannot, when you are talking about this one, we are not talking about expenses. They said it has been expensive. So the accounting, you cannot find it here. It's new. You cannot find it there because they have already expensed it. It's not asset. It's not non-current asset. It's not liability. It's not current liability. We cannot even find it again.
Mr. James, please.
Yeah, it has been expensive. Yes, it has been.
Hello, sir.
Except if it was capitalized. We recognize.
Okay, development cost.
Yeah, but it's a research cost. Abi?
It's a research cost.
It's a research cost. So it was expense of. They did not what? They did not capitalize it. Assuming they capitalize it now, it will be part of the asset. And we recognize it that, yes, accounting people will recognize, but they expense it on. But in that question, they said tax people are what? Until later, but they made payment for it, Abi. Can you read that statement again? How they put it?
Such costs are not permitted as a taxable portion until a later period.
No, the beginning.
Here and the first of March 2020. The company incurred research cost of 100,000 naira.
They've already incurred for it.
Yes.
So which means they paid for it, Abi.
An expense.
An expensive. So the tax people will say, okay, 120, no one. What is the difference?
120,000.
120. Asset or liability?
No, it's subject. I don't know.
It's liability.
Why is it liability?
Because the carry amount of that is less than the tax liability. So
By charging, let's look at it this way. By charging this 120 into expense, will have reduced the profit. Yes or no? Let's assume the profit was 10 before. The profit will become 130. I mean, let's assume the profit was 10 before.
The principle is not here.
The
principle is not here.
The principle is not there.
It's not here for the research.
Go to research. No, go to determination. The research is there. Go to determination. Determination, the under. You will see it under the determination there. Go to the determination.
Yeah, we go look at it.
No, in that material. That you see now.
No, I'm thinking.
So go to the determination. They say research cost. Tax base of research cost is what? Is the cost of research cost. So what is this? What is the cost of research cost here? 120,000. And that is the reason why we are recognizing. Yeah. So the asset is an asset. I want to sneeze, but
it's not coming.
Okay, so the research cost is new. Then the tax base is what? Is 120. Now, want to know why is an asset? Okay, fine. Now, the tax people in the accounting, you have already recognized it as what?
Expenses.
So let's say you have 50,000, or let's say 150,000 before as tax. This has been reduced as a result of what? As a result of the expense you have charged on it. But now, the 150, they are saying, see, this is tax base. What is the difference? 30,000. This 30,000, what do you think has happened? You're supposed to be charged interest, and you're supposed to be charged profit on this. But you are charging what? The profits on 30,000. What has happened? What do you think has happened?
Confusion has happened.
The confusion has happened.
Yes.
Why is the confusion?
Not that I was already got to.
Okay, so go to the assets. Let's go to the deferred assets.
Asset and liability.
Let's go to deferred assets under. Under deferred tax assets, we have assets, we have assets. What sign do we have here?
Yes.
Yes. When the asset is lesser than the tax base. We said we have assets. Yes or no? In your TP, when you are categorizing your TP, how are you going to categorize research? Which is debited. Which means assets. All assets are debited, all expenses are debited. All income are credited, all liability are credited. So it means the research cost will fall under what? Under assets. The same way you treat assets, you will treat the research cost the same way.
Okay, then we should have.
So recognize this research cost as part of what? As part of assets. So we now follow that principle now. This will give us assets. So is the principle still follow now?
So in brackets.
So we put this one in brackets. We call it the assets. We call this one the have. So let's follow. So assuming it's income now, and this one is new, this one is new, it becomes what? It becomes liability. Let's continue. The next one. Okay. Number 3, Abby. What is purchase loan note there?
United purchase loan 300,000 for another company and incurred transaction of 30,000 in relation to the acquisition.
That's all.
Yes.
Okay. What these people are trying to say is that they are capitalizing transaction costs. And that is what they are going to do in accounting. But these people will not allow you to do that. So financial what? Asset, I mean? No, don't worry, Mr. Komi is coming. Mr. Komi is coming with IAS, I mean with a financial history. You will understand more about financial asset and financial liability.
That's example.
So these people, accounting people will say yes, it's 330,000. But the tax people, they will only take the value at what? At par. And what is the value for at par?
300,000.
300,000. What do we have now?
30,000.
30,000 as a difference. Oh, yeah, follow your principle. Asset or liability?
Liability.
Liability, I mean. So we have liability. Number 4. What's the next one?
Oh
yeah.
On the 1st of March 2020, one United borrowed 175,000 naira for the non-group company. The financial liability on dedicated has fair value to profit for loss. One United got cost of 15,000 naira in connection with the borrowing, and this qualifies for tax relief yet in the dedicated of the March 2020.
Okay. The Man United borrow, which is that's the financial what? Liability, I mean.
Yeah.
So they borrow, the original amount is what?
175.
So tax people are dealing with original price.
Yes, not
so original price is 175. But the company now, they said they incurred what? Transaction cost. So, you know, here they added the transaction cost here.
Yes.
Because it's an asset, they capitalize it. But now, because of the borrowing now, they will now remove it. So it will now be 175 minus that 15. What do we get? So they will recognize 160 in their own book of account. And now it's opposite of asset and liability.
I still borrowing cost.
Look at it here. When you want to buy, you buy for 300.
Yes.
You incur 30 naira.
Right.
You capitalize that 30 naira. The total you incur is what? 330. But now you are borrowing. You borrow how much?
5,000.
Can you read that statement again so that I will explain better?
The financial liability, everything I mean. Financial on 30th of March 2020, Man United borrowed 175,000 naira.
The original amount is 175,000 naira.
The financial liability was designated as fair value through profit or loss. Man United incurs cost of 15,000 naira in connection with the borrowing cost. With the borrowing, and this qualifies for tax relief in the year ended.
That's all. So it means 175 is the par.
Yes.
Then the 15,000 will less it. That gives us 160. This is under liability. Don't worry, Mr. Scott is coming today. Under financial instrument. This one is when it is what? When it is asset. So you are lessing the transaction here when it is liability, but when it comes to the assets, you are adding this particular transaction. So the tax people will take the par. Why accountant is doing this, all this, their magic. So what is the difference between the two? 15,000. So 15,000. Asset or liability?
Assets.
Are you sure? Asset or liability?
Liability.
Or accounting position is better than the tax people. Other assets better than.
Make una check am well, yo. Go under liability. I think we did the
It's liability.
So what do we have?
It's liability, I can tell you.
Go to the next one. What is the next one? We have to be fast now. Just go to the principle. Once you get to the principle, you are good to go. Yes. Just hold on there. We don't need small story. Warranty provision. As long as it's provision, accountant will recognize. How much is provision?
200,000.
Accountant will say yes, we have provision. Tax people will say no, the dream. The difference will be 200,000. Liability or tax?
Liability.
This is lab. This is lab, have we?
Asset.
Is it asset? Is it liability?
It's liability.
Oh, yeah.
It should be in jacket. Financial liability should be in jacket.
Which one is jacket?
Okay,
Okay, I think this one should be asset.
Financial liability.
Which one is
Warranty provision is a liability too now. It's under liability, so it should be opposite of this.
That's what I'm saying.
And so the accounting is better than
The carry amount is
But this one is less than now.
Yeah, that's why it's less than. So it should be opposite. That's why I was telling you, it's assets.
No, the first one is correct. This one should be in jacket. That's what I want you to understand. Go back to the principle. Go back to the principle. Everybody. The 200 should be in jackets. Even without thinking, you should know now. Look at the first one. What is the first one we got? These two things are liabilities. When this one is greater, and when this one is lesser than this, we said it's liability. Then when this one is now greater than this, it should be assets. The thing don't do balabala now.
Okay, it's opposite of
Yes.
Is it doing balabala or we
Opposite
understand
of the
what I'm
other
saying?
that is not asset.
This one is not asset.
No.
Why?
We understand.
Go back.
Okay, go to under deferred tax assets.
Which one? The fact that for the
Go back to deferred tax assets, the formula I gave to you.
yeah.
So deferred tax assets, what do you have there?
Assets, blah.
Warranty provision, anything provision is liability. Go to deferred tax asset formula. You know, we have asset at the top, we have liability on under. So under liability, what do you have there?
Greater.
Carrying amount greater than.
That's this.
Is the carrying amount here not greater than the tax base?
This is what liability and not assets.
Which one is liability?
The warranty provision itself.
It's liability. Is it not the liability you checked just now?
Under the factors, it should be under the factors liability.
See, I've given you two. You must understand. I've given you two formulas. One is assets. One is the factors liability. So we have two things. Under the factors assets, we have assets and asset, liability and liability. When this one is lower,
Yes.
this is the factors asset. When this one is greater, this is carrying amount. This is tax base. When this one is greater, that is the factors asset. Yes or no? Now, this one now falls under here.
Why is the other asset not under liability?
They have different formula now. Oh yeah, look at it. The liability. It's not. This is deferred tax asset. This is deferred tax liability.
Yes.
Now, another thing you have done here, repeat it here. Assets, assets. Liability, liability. When this one is greater, when this one is lesser. And you want to determine if it falls under this one or it falls under this one. Now, liability is greater than liability. This one is greater than this. It becomes what? It becomes an asset because this thing, this formula is under the part asset.
Why is it under liability? Look at that first asset. That is the short.
I think I'm going to say, it's an expense.
Asset. Now, the check cost itself is an expense. So since the
look at it. This is research cost. Carrying amount is lesser than the tax base.
I agree with that one.
Carrying amount is lesser than tax base. It's tax assets.
Because research cost itself is an asset. But what about the provision?
When I want to check the research cost, did I check under this liability? Did I use the formula for liability? No. I use the formula for assets.
That's where you say all assets are divided.
See, current assets. This is current asset, Abi.
Yes.
It's an asset. I will now I will look at the situation here. Current carrying amount is greater than what? Tax base.